I want you to imagine that you own an auto insurance company.
Okay, sounds like a stressful job.
It is, right. So you're sitting at your desk going over the day's applications, and two people walk into your office looking for the exact same coverage on the exact same day.
Who are they?
Well, person A is a 19-year-old who, just got their driver's license, and they already have two speeding tickets sitting on their record.
Ouch.
Yeah.
Yeah, that's not great.
No, definitely not. But then you have person B. They're 45. They have 20 years of absolutely flawless, accident-free driving. I mean, no tickets, no fender benders, totally pristine.
The dream customer.
Exactly. And they both drive identical, sensible, mid-sized sedans. So the fundamental question for your business is this. Do you charge them the exact same premium?
I mean, if you do, you should probably just go ahead and start packing up your office because your company is going to be bankrupt by the end of the year.
Right. Which feels instinctively true to all of us. We all know they shouldn't pay the same price.
Obviously not.
But how does an entire industry mathematically and, more importantly, legally justify charging two different people wildly different prices for the exact same legal contract?
It's a huge question.
It really is.
Huh.
So, welcome to today's deep dive. We are unpacking the absolute bedrock of the insurance industry, which is risk classification.
Yes.
And we have a pretty heavy stack of sources today. We're pulling from actuarial textbooks, recent regulatory guidelines from state insurance departments, and a few incredibly dense industry white papers on rate making.
Dense is definitely the right word for those. But it is such a massive topic. I mean, whether you're a professional studying for your CPCU exams or an underwriter trying to sharpen your skills or just someone who wants to understand the financial machinery behind the premiums you pay every month.
Which is most of us, really.
Exactly. So today we're going to look at the mechanics of predicting loss, the legal tightrope of fair pricing, and how this system actually shapes human behavior.
So let's just get right into the mechanics. Because jumping from our hypothetical scenario of the two drivers into the real-world financial architecture of pricing is, well, it's a pretty big leap.
It is.
When I was going through the actuarial texts, I kept trying to find a parallel industry to make sense of it, and my mind immediately went to airline tickets.
Oh, interesting. Okay.
Yeah, like you sit on a flight in this cramped economy seat, and the person next to you might have paid 3 times what you paid because they booked yesterday, whereas you booked 6 months ago.
Right, the classic last-minute panic purchase.
Exactly. So is insurance doing the same thing? Are they just categorizing people to maximize the profit per seat, so to speak?
Okay, I am going to stop you right there because that is a really common misconception, but it completely misses the fundamental math of insurance.
Wait, really? How so?
Well, what airlines do is called revenue management. They price based on demand, price elasticity, and honestly, your desperation as a buyer.
That makes sense.
Yeah, if you need a flight tomorrow, they know you're going to pay top dollar.
Mm.
But insurance pricing operates on a completely different scientific principle. It's based entirely on the statistical probability of a loss occurring.
So the airline charges for desperation, but the insurer is charging for mathematical risk.
Precisely that. The formal definition of risk classification is the process of grouping insurance applicants into categories based on similar risk characteristics. And the actuaries are really looking at two very specific metrics here.
Which are?
First is claim frequency. That's just the sheer mathematical likelihood that you're going to file a claim in the first place.
Okay, frequency.
And second is claim severity, meaning if you do actually have a claim, how expensive is it going to be?
Ah, okay. So frequency and severity. Going back to our two drivers, the 19-year-old with a heavy foot has a much higher statistical probability of hitting something, which hits that frequency metric.
Right. And if they are actively speeding, the physical impact of that collision is going to be harder, meaning the property damage and the bodily injury will be far more expensive to fix.
Which is severity.
Exactly. The insurer recognizes that their expected losses are entirely different from the 45-year-old with the clean record. They just cannot mathematically exist in the same pricing category.
Which brings us to a term that came up constantly in those dense white papers, actuarial fairness.
Yes, a crucial concept.
It sounds like this lofty, philosophical idea, but the texts treat it like a matter of literal financial life or death for the company.
Because it is.
So why is it so critical that these two drivers are separated? What happens if an insurer decides, we're just going to be egalitarian and charge everyone a flat average rate.
Well, that egalitarian approach triggers something called adverse selection, and it leads to what actuaries literally call a death spiral.
A death spiral, that sounds dramatic.
It is dramatic. Let's look at the mechanism. Let's say the truly fair premium for the safe 35-year-old is $500, and the fair premium for the risky 19-year-old is $1,500.
Okay, I'm following.
If you average that out and decide to just charge them both a flat $1,000, what actually happens?
Well, the 45-year-old looks at that bill and realizes they're being severely overcharged. I mean, they are financially subsidizing the teenager at that point.
Right.
So they shop around, they find a competitor who accurately prices their low risk at $500, and they leave your company.
And who stays?
The 19-year-old. Because $1,000 is a massive discount for them. They're thrilled.
Exactly. Now, your insurance pool is entirely composed of high-risk drivers. Those $500 safe drivers are gone. So your average expected loss per driver just shot way up.
Oh, wow. Okay, I see where this is going.
Yeah, to cover those new losses, you have to raise your flat rate to $1,500 just to break even. But wait, now the people who are true $1,000 risks feel overcharged. So they leave.
And the pool just gets riskier and riskier.
The premiums go higher and higher until the company literally collapses. That is the adverse selection death spiral. Actuarial fairness is the firewall against that happening. The fundamental mathematical rule is same risk equals same price.
Okay, the math makes total sense. We know why people must be separated to prevent the whole system from collapsing.
Right.
But let's talk about the operational side for a second, because even in professional circles, you'll hear people use terms interchangeably that actually mean very different things.
Oh, constantly.
Yeah, like I hear professionals say, our underwriters classify the risk, or, the underwriter priced this policy. But the texts are very clear that this is a fundamental misunderstanding of the workflow.
It is a massive stumbling block. Honestly, if you take one operational truth away from this deep dive, especially if you're navigating professional exams, let it be the distinct boundary between underwriting and risk classification.
So they aren't just synonyms for the same job.
Not at all. They are two entirely distinct phases in the life cycle of a policy.
Okay, let's break down that boundary then. If an underwriter isn't classifying the risk, what exactly are they doing?
Underwriting is fundamentally about risk selection. The underwriter evaluates the applicant against the company's internal guidelines and their overall risk appetite. They are the gatekeeper.
The gatekeeper, okay.
They look at that 19-year-old and ask, do we even want to write a policy for someone with 2 speeding tickets? Does our company have the capacity for this kind of risk right now?
Ah, I see.
The underwriter's making a binary decision, yes or no, accept or reject.
So the underwriter just decides if you're allowed into the building.
Exactly.
But once you're inside, how do we figure out what you actually pay?
That is where risk classification comes in. Classification is the tool used for rate making. It's the accounting and actuarial side of the house.
Okay.
So the underwriter said, yes, we will take this driver.
Yeah.
Now, the classification system uses those risk characteristics like age, driving history, vehicle type, to assign the driver to a specific rating class. Underwriting is yes or no. Risk classification is how much.
That distinction is incredibly helpful. The underwriter ensures the risk fits the strategy, and classification allocates the right slice of the premium pie.
You got it.
But, as we assign people to these different classes based on their personal characteristics, like their age, their location, their history, we hit a very uncomfortable friction point.
The legal and social friction, right?
Yes. Treating people differently based on their demographics or personal, in literally any other industry, that is the exact definition of discrimination.
It is.
We are putting people in boxes and charging them more money because of the box they're in. How do state regulators possibly allow this?
Well, this is where we have to separate our social intuition from statistical reality. The entire regulatory framework relies on a really crucial legal distinction, which is fair discrimination versus unfair discrimination.
Okay, I have to say, fair discrimination sounds like a complete oxymoron to the general public.
It definitely does. But regulators actually mandate it. Remember actuarial fairness.
Right, same risk, same price.
Exactly. Regulators require premiums to be adequate and not excessive. If you charge the safe 45-year-old the same as the risky 19-year-old, regulators actually consider that unfair.
Wow. Okay.
Yeah, fair discrimination means treating different risks differently, but strictly based on hard actuarial data and expected losses.
Okay, let's look at a gray area then, because this isn't always as clean as looking at a driving record. What about credit scores?
Oh, that's a big one.
Yeah, auto insurers often use credit-based insurance scores to determine premiums. And to a lot of people, that feels incredibly unfair. Like, why should missing a credit card payment mean you pay more for car insurance?
It's a very common question.
It just feels like it disproportionately impacts lower income demographics. It really feels like unfair discrimination.
That is a perfect example of the friction between what is mathematically predictive and what feels socially acceptable.
Mm.
To understand why regulators permit it, at least in most states, we have to look at the 5 criteria a classification system must meet to be considered legal and fair.
It can't just be a hunch from the underwriter.
Exactly. It has to pass these tests.
Let's run the credit score scenario through those 5 criteria. What's the very first hurdle?
The classes must be homogeneous, meaning if we group people with low credit scores together, do they actually share similar risk profiles? The data has to prove true similarity within that group.
Okay. And the second?
It must be objective. This is actually why credit scores are used so heavily. An objective system doesn't rely on bias or a gut feeling from an agent. A credit score is a hard, indisputable number. The criteria are clearly defined and consistently applied by a computer model, not human judgment.
Right, I get that. But even if it's objective, there has to be some logistical limit, right? Like, you can't ask a driver to submit to a full psychological evaluation to prove they aren't prone to road rage, even if that data would be highly objective.
You're jumping ahead, but yes. Which brings us to the third criterion, practicality.
Ah, practical.
The cost and the effort of gathering the data simply cannot outweigh the value of the policy. Pulling a credit report is instantaneous, and it costs pennies. It is highly practical.
Okay, so we have homogeneous, objective, and practical. What about the actual math itself?
The fourth requirement is that the system must be actuarially sound.
Meaning what, exactly?
The premiums charged to the lower credit score tier must mathematically align with the actual verified losses that specific group generates. The insurer must prove to the state that this group truly costs them more money in claims.
Okay, and the final criterion?
It must be predictive of future losses. This is the real crux of the whole credit score debate. Actuarial studies consistently show a very strong statistical correlation between credit history and the likelihood of filing a future insurance claim.
But why? What's the connection?
Well, the mechanism behind why is heavily debated. Maybe people under financial stress are just more distracted behind the wheel. Or maybe they defer maintenance on their vehicles, leading to accidents. We don't necessarily know why.
But the math is there.
The mathematical correlation is undeniable. And because it is predictive, regulators deem it fair discrimination.
So unfair discrimination then would be using a trait that just flat out fails those tests.
Yes, redlining based on race, religion, or national origin. Those factors have zero actuarial correlation to the likelihood or severity of a future claim.
Right, they fail the predictive test.
Exactly. Using them is not predictive, it is not actuarially sound, and it is highly, highly illegal.
That framework, homogeneous, objective, practical, actuarially sound, and predictive, it really clarifies how the industry justifies its pricing models to the state.
It's the blueprint.
But, for you listening, this can still feel very deterministic. Like, the model runs your data, puts you in a high-risk box, and boom, you are trapped paying high premiums forever. Does the system allow a policyholder to actively change their classification?
It absolutely does. And this is what often gets lost in the dense actuarial math. Classification is actually a highly effective tool for behavioral economics.
Behavioral economics, how so?
Insurers use a mechanism called merit rating to dynamically reward or penalize individual behavior over time. You are never trapped in a base rate forever.
So how does that mechanism actually adjust? Give me a real-world example of how my behavior alters the math.
Well, let's go back to our 19-year-old. They have a high base classification because of their age and the tickets.
Right.
But the insurer might offer a good student discount. Actuarial data shows a correlation between maintaining a B average and being a responsible driver. By offering a premium credit, the insurer is actively incentivizing the teenager to study and act responsibly.
That's fascinating.
Or consider property insurance. If a homeowner installs a central fire alarm system, they receive a premium credit.
Because the alarm lowers the expected severity of a fire claim, right?
Yes.
The fire department arrives faster, the house doesn't burn to the ground, the insurer pays out less, so the homeowner pays less up front.
Exactly. That is merit rating shaping behavior. But it actually goes even further for commercial businesses through a concept called experience rating.
Experience rating. The white paper spent a lot of time on this. This is where a business's own historical data sort of overrides the industry average, right? How does that math work?
It relies on two fundamental concepts: loss ratio and credibility.
Okay, let's take those one at a time.
Sure, let's say you own a manufacturing plant. The underwriter looks at your loss ratio, which is simply the ratio of claims paid out compared to the premiums you've paid in.
Simple enough.
Right. If you pay $100,000 in premium and the insurer only pays out $20,000 in claims, you have a phenomenal 20% loss ratio.
So if my loss ratio is consistently better than the average manufacturing plant, my premium drops.
Yes, but the insurer has to determine exactly how much of a discount to give you, which introduces that second concept: credibility.
How credible the data is.
Exactly. Think of flipping a coin. If you flip it twice and get heads both times, you wouldn't confidently state that the coin always lands on heads. It's just too small of a sample size.
Right, it's just luck at that point.
But if you flip it 10,000 times, the statistical reality reveals itself. That is the law of large numbers.
So a small business with 0 claims over a year might just be getting lucky. Their data has low credibility.
It's exactly. But a massive corporation with thousands of employees and 0 claims, that is not luck. That is a statistically significant culture of safety.
Oh, I see.
Their data has high credibility. So the higher the credibility, the more the insurer bases the premium on the company's actual experience rather than the generic industry average. It is a direct financial reward for implementing safety protocols and actively managing risk.
That is just so cool. It takes these abstract statistical concepts and turns them into tangible, real-world actions.
It really does.
Getting a fire alarm literally saves you money. Training your employees to lift heavy boxes safely literally puts cash back on the company's balance sheet.
It aligns everyone's interests perfectly.
It does. Now, for the professionals listening, we have covered a lot of ground today. We've unpacked frequency and severity, the adverse selection death spiral, the distinct boundary between underwriting and classification, the legal tests for discrimination, and the behavioral incentives of merit rating.
It's a heavy list.
It is. So instead of just reciting a syllabus, how do these themes weave through the actual DNA of an insurance company? Like if I'm taking my CPCU exams, why is mastering this so critical across every single department?
Because a failure in classification literally cascades through the entire organization. This shows up on CPCU 520 for operations, 530 for law, 540 for finance. It's everywhere.
Wow. Okay.
Yeah, think about it. If you misclassify risks, your finance department is projecting premium revenue that mathematically will not cover the eventual losses. Your actual solvency is threatened.
And what about on the legal side?
Well, your legal and compliance teams are suddenly going to be fielding inquiries from the State Department of Insurance.
Yeah.
They'll have to defend against accusations of unfair discrimination because your models aren't actuarially sound or predictive.
That's a nightmare scenario. What about operations?
Operations in IT rely on these classifications to build the actual policy administration systems. If the underwriting guidelines and the rate-making classifications are conflated by the staff, agents won't be able to properly quote a policy, and underwriters will be constantly fighting system errors.
So it just breaks the whole machine.
Exactly. Risk classification is the nervous system of the company. It touches absolutely everything.
The golden rule to remember for the exams, and just for the industry, is same risk equals same price. Underwriting says yes or no. Classification says how much.
Perfect summary.
Actuarial fairness isn't about social equality. It is about mathematical equity. It is literally the only way the insurance pool remains stable, competitive, and solvent.
Completely agree.
But, as we wrap up this deep dive, there is one final concept from our actuarial sources that kind of throws a massive wrench into everything we have just discussed.
I know where you're going with this.
Yeah, we have spent this entire time explaining how actuaries use past behavior to predict future losses, right?
We have. But human behavior is not a static variable, which introduces the ultimate puzzle: moral hazard.
Exactly. Moral hazard. It's the behavioral change that occurs simply because someone knows they're protected by a safety net.
It's a fascinating phenomenon.
It is. Imagine our 45-year-old driver from the beginning. They have 20 years of flawless data. The actuary classifies them as a preferred risk, and they lock in an incredibly low premium.
The math is settled. They're a safe bet.
But then they sign the policy. They realize they have fantastic comprehensive and collision coverage. Suddenly, they feel kind of invincible.
Oh, no.
Right. They start driving 20 miles over the speed limit. They stop checking their blind spots. They start texting at red lights. The very act of providing the insurance policy changes the behavior of the insured person.
Which means the historical data the insurer used to classify them is now completely disconnected from their current reality.
Yeah.
The predictive model is fundamentally broken by the product it is trying to price.
It is a total paradox.
Right.
I mean, how can an industry accurately classify a risk when the safety net they provide actively encourages the customer to become riskier?
It's the multi-million-dollar question.
Do merit rating and experience rating catch up fast enough to correct the premium before the insurer takes a catastrophic loss? How do you mathematically model human nature when human nature changes the moment you model it?
You really can't.
No, you can't. And that is a puzzle for you to mull over long after this deep dive ends. Because in the world of risk, the data might be perfectly objective, but human behavior will always be the wild card. Thanks for joining us for this deep dive. Keep questioning the models, keep looking at the data, and we will see you next time.